You think you own stock. You're wrong. Right now, you might have shares of Apple in your retirement account, Tesla in your portfolio, Amazon in your 401k. You check the balance, watch it grow, feel like an investor. But here's the paradox. You own nothing. BlackRock owns everything. Not because they stole it, not because of some conspiracy, because of a legal structure so elegant, so invisible, that even calling it a monopoly feels inadequate. This isn't about corruption or crime. This is about architecture. The architecture of ownership itself. And once you see it, every assumption you have about capitalism collapses. There's a company managing $10 trillion in assets. Not billion, trillion, with a T. That's larger than the GDP of every country on Earth, except the United States and China. That's more than all the physical and digital currency circulating in America right now. That's 40% of the entire U.S. economy sitting in the hands of one firm. One. This company is the largest shareholder in Apple, and Microsoft, and Amazon, and Tesla, and ExxonMobil, and J.P. Morgan Chase, and Pfizer, and 496 other companies in the S&P 500. When you add it all up, this one company has its fingers in virtually every major corporation that touches your life. The phone in your pocket, the car you drive, the drugs you take, the bank that holds your mortgage, the oil that heats your home. All of it connected to one central node. That company is BlackRock. And here's what most people get wrong. They think BlackRock is a bank. It's not. Banks take your deposits and lend them out. Banks are regulated under banking law. Banks have FDIC insurance and reserve requirements. BlackRock does none of that. BlackRock is an asset manager. It manages other people's money. Your pension fund, your university's endowment, your 401k, your index fund. BlackRock takes that money, invests it according to your chosen strategy, and charges you a fee. Usually somewhere between 0.03% and 2%, depending on the product. Sounds boring, right? Sounds like just another financial services company shuffling papers and collecting tiny fees. But here's where it gets strange. Michael Chen, a software engineer in San Jose, bought his first ETF in 2019. He remembers sitting at his kitchen table on a Sunday morning, coffee going cold, finally pulling the trigger on the iShares S&P 500 ETF after months of reading r/personal finance threads. Ticker symbol IVV. 3 letters that represented his entry into wealth building, his escape from living paycheck to paycheck. He invested $8,000, everything he'd saved that year after rent and student loans. He felt like a real investor. He owned 500 companies now. Fractional shares, sure, but ownership. His ownership. What Michael didn't know, what nobody told him when he clicked buy, was that he didn't actually own anything. BlackRock did. Michael owned a claim to future returns, but the actual shares, the voting rights, the power to influence corporate decisions at Apple, Microsoft, Amazon, all of that belonged to BlackRock. And BlackRock votes those shares, not Michael. Multiply Michael's story by millions, tens of millions. BlackRock manages money for retail investors through ETFs, for pension funds, representing teachers and firefighters, for sovereign wealth funds, representing entire nations. All of them think they own stock. None of them vote. BlackRock votes on every shareholder resolution, on every board election, on every merger and acquisition. Picture the visual. A massive web, threads extending from one central point to 500 corporate headquarters across America. Each thread representing ownership, each thread representing control. But wait, if BlackRock just manages money and votes shares on behalf of clients, isn't that just how asset management works? Doesn't Vanguard do the same thing? Doesn't State Street? Yes, But here's the scale difference. BlackRock manages 10 trillion. Vanguard manages 8 trillion. State Street manages 4 trillion. Together, these three firms control $22 trillion. That's 90% of the United States GDP. Three companies. And BlackRock is the largest, the most powerful, the most politically connected. Jennifer Martinez used to work as a proxy voting analyst at a mid-sized asset manager in Boston before the firm was acquired in 2017. She spent her days reviewing shareholder proposals, researching board candidates, making voting recommendations. It was tedious work, but it mattered. Her firm managed $12 billion, and every vote represented real clients with real stakes. Then BlackRock bought the firm. On her last day, cleaning out her desk, Jennifer looked at the org chart of her new employer. BlackRock's proxy voting team handled trillions in assets with a staff smaller than her old firm used for $12 billion. The math didn't work. There was no way they could give serious attention to every vote. And they didn't need to. BlackRock had something else. An algorithm. A system. A set of predetermined guidelines that automatically voted shares across the entire portfolio. Efficient, yes, but also mechanical, impersonal, and wielding more power than any group of humans in corporate history. The system is called Aladdin. Asset Liability Debt and Derivative Investment Network. It started as a risk management platform when BlackRock was founded in 1988. The brainchild of Larry Fink, a bond trader who just lost $100 million on a bad mortgage bet and got fired. Fink learned something crucial from that failure. If you can measure risk better than everyone else, you can beat everyone else. So he built Aladdin. And Aladdin became BlackRock's secret weapon. Today, Aladdin doesn't just manage BlackRock's 10 trillion, it manages 21 trillion in total assets across the global financial system, including for BlackRock's competitors. Think about that. BlackRock's AI system is running risk analysis for firms that compete with BlackRock. It's like Google managing the servers for Bing and Yahoo while also competing against them. The visualization here is critical. Imagine a single brain, pulsing with data, connected to nearly every major financial institution on the planet. Now here's the question nobody asks. What happens when one company is the largest shareholder in all the major airlines? United, Delta, American, Southwest. Same owner. What happens when one company is the largest shareholder in all the major banks? JP Morgan, Bank of America, Wells Fargo, Citigroup. Same owner. What happens when one company owns significant chunks of Coca-Cola and Pepsi, Exxon and Chevron, Pfizer and Johnson & Johnson? Competition dies. And when competition dies, you pay more. For everything. But we're getting ahead of ourselves. Because before we can understand what BlackRock's monopoly means for prices, wages, innovation, and democracy itself, you need to see exactly how BlackRock became this powerful. You need to understand the mechanism, the architecture, how one company went from 0 to 10 trillion in 36 years. How ownership became concentrated without anyone noticing. How the end of capitalism happened while everyone was watching the stock market go up. That story starts with a crisis, a phone call, and a choice the Federal Reserve made that changed everything. 1988, the year BlackRock was founded. To understand why that year matters, you need to understand what was happening to money itself. For most of human history, if you wanted to own part of a company, you bought stock directly. You held a certificate. Your name appeared in the company's books. When the board met, you could vote. If you owned 100 shares of General Motors, you had 100 votes. Simple, direct, physical ownership. But by the 1980s, something was changing. The paperwork was becoming overwhelming. Millions of shareholders, billions of shares, changing hands every day. The system couldn't handle it. So Wall Street created a solution. Street name registration. Instead of shares being registered in your name, they'd be registered in your broker's name. Your broker would hold the shares on your behalf. You'd still get the dividends, still benefit from price appreciation, but the broker would vote, or, more accurately, the broker would pass the voting rights to whoever actually held the shares in the custody chain. Most people get this wrong. They think when you buy stock through Fidelity or Schwab votes your shares. They don't. They're just the interface. The actual shares are held by a custodian, usually a massive institution like State Street or Bank of New York Mellon. And increasingly, those shares aren't individual stocks at all. They're bundled into mutual funds, or ETFs. And the fund manager, the company that decides the fund's strategy and executes the trades, also gets the voting rights. That company is often BlackRock. Picture this as plumbing. You think you're drinking straight from the well, but actually, water flows from the well into a reservoir, then through a filtration plant, then through municipal pipes, then into your house. At each stage, someone else controls the flow. You get the water, sure, but you don't control the infrastructure. And the infrastructure is where power lives. David Stern worked for a Connecticut pension fund in the early 2000s. His job was managing retirement money for 38,000 state employees, teachers mostly, some municipal workers. $2 billion total. David took the responsibility seriously. These were people who'd spent their lives in public service, counting on that money for retirement. Every quarter, David's team would review the portfolio, vote proxies, engage with management at companies where they held large positions. It was labor-intensive, but it mattered. Then in 2007, the board hired a consultant. The consultant's recommendation was simple. Move 70% of the portfolio into passive index funds. Lower fees, better diversification, less work. David argued against it. He understood the math of what they were giving up. But the board saw the fee savings. 0.03% versus 1%. On $2 billion, that was millions saved annually. The decision was made. By 2009, most of the pension fund's assets were in BlackRock and Vanguard index funds. David still had a job, but he wasn't really managing money anymore. He was managing vendor relationships, the voting power, the actual ownership rights representing 38,000 teachers now belonged to BlackRock. And BlackRock would vote those shares according to BlackRock's guidelines, not Connecticut's. Multiply David's story across the country, across the world. Pension funds, endowments, sovereign wealth funds, insurance companies, all making the same rational decision. Move to passive, save on fees, get market returns. Each decision perfectly logical in isolation. But the aggregate effect was a massive transfer of voting power from dispersed owners to three giant asset managers, BlackRock, Vanguard, and State Street. Here's the mechanism in plain language. When you buy an index fund, you're buying a slice of every company in that index. The S&P 500 index fund gives you exposure to 500 companies. You own a tiny fraction of each. But you, personally, cannot vote those shares. The fund manager votes. BlackRock manages $400 billion just in the iShares S&P 500 ETF. That $400 billion represents millions of votes in every S&P 500 company. Apple's annual shareholder meeting? BlackRock shows up with millions of votes from people who don't even know there's a meeting. Microsoft's board election? Same thing. Amazon's executive compensation vote? BlackRock decides. Now here's the question that should bother you. What are BlackRock's incentives? Remember Michael Chen from earlier, the software engineer who bought IVV thinking he was building wealth. Michael wants his shares to increase in value. That's his incentive. But BlackRock's incentive isn't just Michael's returns. BlackRock's incentive is asset growth. More assets under management means more fees. And what drives asset growth? Market performance, yes, but also stability. BlackRock doesn't want volatility. Volatility scares investors. Scared investors pull money out. So BlackRock votes for stability, predictability, and incumbent management. Not disruption. Not creative destruction. Not competition. Sarah Jennings worked in BlackRock's corporate governance team from 2015 to 2019. She left after realizing something that disturbed her. BlackRock's proxy voting guidelines, the rules that determined how trillions of dollars in shares would be voted, were made by a team of about 50 people. 50 people making voting decisions that affected the entire global economy. And those guidelines were, by necessity, broad. They had to be. You can't craft nuanced voting strategies for 5,000 companies with 50 people. So the guidelines became formulas. Does the board have independent directors? Yes or no? Is executive compensation tied to performance metrics? Yes or no? Checkboxes. Algorithms. Sarah remembers sitting in a meeting where someone asked what they'd do if two portfolio companies were proposing a merger that would reduce competition. The answer was, depends on whether it increased shareholder value for both companies. Not whether it was good for consumers. Not whether it violated antitrust principles. Shareholder value. And since BlackRock owned shares in both companies, shareholder value meant the merged entity should be more profitable, which usually meant less competition was fine. This is the unexpected twist that nobody talks about. We think of monopolies as one company dominating a market. Standard Oil controlling 91% of oil refining. A TNT controlling all telecommunications. But BlackRock's monopoly is different. BlackRock doesn't dominate markets. BlackRock owns pieces of all the companies in every market. This is called common ownership. And common ownership kills competition just as effectively as traditional monopoly, but legally. Here's how. Imagine you own a coffee shop. Your competitor across the street also sells coffee. You compete on price, quality, service. That's capitalism. Now imagine the same investor owns 70% of your shop and 70% of your competitor's shop. What happens? You still compete, but not as hard. Because if you drop prices to steal customers, you hurt your competitor's profits. And your investor owns both of you. Your investor doesn't want you fighting. Your investor wants both shops profitable. So prices stay high, customers pay more. But it's not illegal, because neither shop individually dominates the market. The dominance is structural, hidden in the ownership layer. Studies have proven this. A 2015 paper by Jose Azar and his co-authors found that common ownership by BlackRock, Vanguard, and State Street in the airline industry led to ticket prices 3 to 7% higher than they would be otherwise. Billions of dollars extracted from consumers. Not through collusion, not through price fixing, through ownership structure. The airlines don't need to talk to each other. They just need to see that their largest shareholders are the same. And those shareholders don't want a price war. Think about the visualization here. Imagine 4 airlines, 4 separate companies, competing routes. But pull back the camera. Zoom out. Above the airlines, you see threads of ownership, all converging to 3 points. BlackRock, Vanguard, State Street. The airlines think they're independent, but they're puppets, and the strings lead to the same hands. Robert Torres retired from United Airlines in 2018 after 32 years as a pilot. He'd watched airline competition change over his career. In the 90s, airlines actually competed. They'd match prices, offer better service, fight for routes. But by the 2000s, something shifted. Prices went up across the board. Fees multiplied. Baggage fees, seat selection fees, change fees. And all the airlines did it simultaneously. Not because they colluded. Robert checked. There were no secret meetings. But they didn't need meetings. They all had the same owners. And those owners wanted revenue maximization, not market share wars. Robert paid more for his own tickets in retirement than he paid as an employee with discounts decades earlier. The invisible hand of the market wasn't pushing prices down anymore. It was holding them up. This is the first mini-climax. The moment passive investing became dominant enough to break the competition mechanism that capitalism relies on. And it happened quietly. No law changed. No regulation shifted. Just millions of rational individual choices to buy index funds, aggregating into a structural monopoly. But airlines are just one industry. What happens when the same ownership structure exists in banking, in pharmaceuticals, in technology, in energy? What happens when BlackRock is the largest shareholder in Exxon and Chevron, Pfizer and Johnson & Johnson, JP Morgan and Bank of America? The answer is already here. You're living in it. You just didn't know what you were looking at. And we haven't even gotten to the part where BlackRock became the Federal Reserve's partner, where the line between government and private finance dissolved completely, where BlackRock stopped being just an asset manager and became something else entirely. That transformation started with a crisis. March 2020, and a phone call that changed March 15, 2020. The S&P 500 had just suffered its worst single-day drop since 1987. The COVID pandemic was shutting down the global economy. Credit markets were freezing. Corporate bonds, the lifeblood of business financing, had stopped trading. Companies couldn't borrow. Banks were hoarding cash. The entire financial system was on the edge of collapse. And the Federal Reserve, the most powerful financial institution in the world, picked up the phone and called BlackRock. Not a bank, not a government agency. BlackRock, a private, for-profit corporation. The Fed needed someone to manage its emergency asset purchase program. Billions, eventually trillions, in corporate bonds and mortgage-backed securities that the government would buy to stabilize markets. This had never been done before. The Fed had always managed its own programs. But in 2020, facing the fastest market collapse in history, they outsourced to BlackRock, the company that already managed $10 trillion in private assets, the company that already owned pieces of every major corporation, the company whose Aladdin system already ran risk management for the entire financial industry. That company would now execute the Federal Reserve's policy. Think about what this means. Picture the visual. On one side, you have BlackRock managing client money, voting shares, advising corporations. On the other side, you have the Federal Reserve setting monetary policy, determining which assets to buy, essentially deciding which companies survive and which fail. And in March 2020, these two sides merged. BlackRock became both player and referee. They managed private money and executed public policy. They owned corporate bonds and decided which corporate bonds the government would buy. This isn't a conflict of interest. This is the demolition of the line between public and private power. Here's what most people get wrong about that phone call. They think the Fed hired BlackRock because BlackRock had expertise. True, but the deeper reason was infrastructure. BlackRock's Aladdin system was already plugged into every major financial institution: banks, hedge funds, pension funds, insurance companies. They all used Aladdin for risk management. The Fed couldn't build that infrastructure in time. They needed it immediately. So they rented it from a private company that also competed with the institutions being saved. Elena Volkov worked as a fixed-income trader at a mid-sized asset manager in New York. When COVID hit, her firm's corporate bond portfolio collapsed. Investment-grade bonds that had been rock solid suddenly couldn't find buyers. Prices plummeted. Her clients, retirees mostly, were watching their savings evaporate. Elena spent 18-hour days on the phone trying to sell bonds, trying to raise cash, trying to meet redemption requests. Nobody was buying. Then, in late March, the Fed announced its corporate bond purchase program. Managed by BlackRock, within days, bid-ask spreads tightened. Buyers appeared. Prices stabilized. Elena's portfolio recovered. Her clients' money was saved. She felt relief, but she also felt something else. She pulled up the list of bonds the Fed was buying. Then she pulled up BlackRock's holdings. The overlap was significant. The Fed, through BlackRock, was buying the exact bonds that BlackRock's own clients owned. BlackRock was stabilizing its own portfolios with government money. It was legal. It was even logical. But Elena couldn't shake the feeling that she'd just watched the financial equivalent of insider trading happen in broad daylight. The firm with the most information about which bonds were troubled, because they owned those bonds, was the same firm deciding which bonds the government would rescue. This is the first micro-hook, the moment when government policy and private profit became indistinguishable. And it wasn't temporary. The relationship continued. Today, BlackRock still advises the Federal Reserve, still consults with the Treasury Department, still sits in meetings where policy is made. Larry Fink, BlackRock's CEO, has more access to the Fed chairman than most elected officials. He doesn't need to lobby. He's already inside. But the Fed relationship is just one mechanism. BlackRock's real power comes from 5 interlocking systems. Remember David from Part 2, the pension fund manager who watched his voting power transfer to BlackRock? That was Mechanism 1, passive fund dominance. Mechanism 2 is proxy voting without accountability. BlackRock votes trillions in shares, but those votes aren't public in real time. You only find out how BlackRock voted after the meeting happens. There's no debate. No input from the actual beneficial owners. Just BlackRock's 50-person team making decisions for millions of people. Mechanism 3 is Aladdin, the AI system that manages $21 trillion, including for BlackRock's competitors. BlackRock sees everyone's positions, everyone's risks, everyone's strategies. It's like playing poker when you can see everyone else's cards. Mechanism 4 is advisory. BlackRock advises central banks, governments, and corporations on policy, while simultaneously managing investments affected by that policy. And Mechanism 5, the one nobody talks about, is common ownership. BlackRock owns pieces of competing companies in the same industry, eliminating the incentive for those companies to compete. Now let me show you how this plays out in the real world. Not in theory, in your life. Marcus Webb works as a baggage handler at Dallas-Fort Worth International Airport. He's 43, been with American Airlines for 11 years. In 2019, Marcus made $42,000. In 2024, he made $44,000. A 5% raise over 5 years. Meanwhile, American Airlines revenue increased by 32%. The airline's stock price doubled. Executives received multi-million-dollar bonuses. But Marcus, who loads the bags that make the flights possible, got 5% over 5 years. Why? Because American Airlines doesn't need to compete for workers. Neither does United, or Delta, or Southwest. They all have the same largest shareholders: BlackRock, Vanguard, State Street. When all the airlines are owned by the same investors, those investors don't want the airlines bidding up wages. They want labor costs controlled across the entire sector. This is common ownership in action. It doesn't require a conspiracy. It doesn't require executives from different airlines meeting in a dark room. It requires nothing except ownership structure. The invisible hand of the market, the one that's supposed to drive wages up when workers are scarce, has been tied behind its back. And Marcus, loading bags in a 100-degree Texas summer, doesn't know why his wages have stagnated. He just knows something feels broken. A 2018 study by economists Azar, Schmaltz, and Teku found that common ownership by the big three asset managers reduced wages in affected industries by approximately 10%. 10%. Not because companies colluded, because they didn't need to. Their owners preferred it. Think about what that means across the entire economy. Teachers, nurses, retail workers, mechanics, all earning 10% less because their employers are owned by the same shareholders who don't want labor competition. This isn't market failure. This is market design, and it's extracting hundreds of billions of dollars from workers every year, transferring it to shareholders, many of whom are the same workers through their 401s. So you're being paid less at work to increase the returns on your retirement account, which BlackRock manages and votes without asking you. Here's your rage moment. Pause this video for a second and think about this. You, personally, own shares through index funds. Those shares represent voting rights. Rights to influence how companies are run, how executives are paid, how workers are treated. But you've never voted them. You don't even have access to vote them. BlackRock votes for you. And BlackRock consistently votes in favor of management, in favor of executive compensation packages, in favor of policies that benefit shareholders over workers. Even when you are the worker, even when the vote is against your own immediate interest. You've been paying BlackRock fees to vote against you, and you didn't know because the system is designed to hide this. The paperwork says you own stock. The legal reality is you own a derivative, a claim to economic returns, but not power. BlackRock has the power, and they're using it to reshape capitalism into something unrecognizable. Now let me show you the second unexpected twist. This one is about competition itself. Standard Oil controlled 91% of one market and got broken up by the Supreme Court in 1911. But BlackRock controls 7% of every market. Which is worse? At first glance, Standard Oil seems more dangerous. 91% is market domination. 7% is barely a meaningful stake. But here's what the Supreme Court in 1911 didn't understand, and what we're only now realizing. Owning 7% of all competitors is more powerful than owning 91% of one company. Because when you own all the competitors, you don't need to crush them. You need them to coexist profitably. Standard Oil had to destroy rivals. BlackRock needs rivals to cooperate. And cooperation among competitors is just a polite word for cartel behavior. Remember Sarah from Part 2, the BlackRock corporate governance analyst who left because she understood what was happening? Sarah tried to raise concerns internally. She wrote memos. She presented data showing that common ownership was suppressing competition. The response she got was telling. Nobody disagreed with her analysis. They just didn't care. Because BlackRock's business model depends on market concentration. If companies competed aggressively, profit margins would shrink. If profit margins shrink, stock prices fall. If stock prices fall, returns decline. If returns decline, investors pull money from funds. If investors pull money, BlackRock's assets under management decrease. And assets under management is how BlackRock makes money. So BlackRock's incentive is not competitive markets. BlackRock's incentive is concentrated, stable, profitable markets. Which means high prices, low wages, and minimal disruption. Catherine Liu bought her first home in Austin in 2021. 32 years old, software product manager, finally saved enough for a down payment. She'd been watching the housing market for 3 years, waiting for prices to stabilize. They never did. Every house she bid on went to an institutional buyer offering cash, 20% over asking, no inspection. She lost 12 bids before finally getting one accepted at 38% above listing price. Catherine later found out that 5 of the houses she'd lost were bought by investment firms whose largest shareholder was BlackRock. They weren't buying to flip, they were buying to rent, converting ownership into perpetual cash flow. Catherine would spend the next 30 years paying a mortgage that was 15% higher than it should have been, because institutional investors with unlimited capital had turned housing into a financial asset. The American dream of homeownership was being transformed into the American reality of permanent rent-paying. And BlackRock was leading the charge, not directly buying houses themselves, but owning shares in dozens of companies that were. Invitation Homes, American Homes for Rent, Tricon Residential, all held in BlackRock funds, all executing the same strategy. Buy single-family homes, rent them, hold forever. Catherine will never own as many homes as BlackRock owns shares in companies that own homes. The math doesn't work anymore. This is the second microhook. The realization that BlackRock isn't just managing money. BlackRock is restructuring society. From wages to housing to corporate governance, BlackRock's voting power and ownership stake is rewriting the rules of capitalism itself. And it's happening without debate, without legislation, without anyone voting except BlackRock. One more thing, and this is critical. BlackRock's power is accelerating. In 2000, passive index funds managed 5% of U.S. equity assets. By 2024, they manage over 50%. By 2030, analysts project 70%. At 70%, BlackRock, Vanguard, and State Street will control voting majorities in most large companies. Not individually, but collectively. And their voting patterns are remarkably similar. They're not competing with each other on governance. They're harmonizing, creating a unified ownership class that controls corporate America without owning corporate America outright. It's elegant, it's invisible, and it's perfectly legal. Elena, Marcus, Catherine, they're all living in the world BlackRock built. A world where returns flow to shareholders, costs flow to workers and consumers, and power flows to whoever controls the votes. They don't know BlackRock's name. They don't understand the mechanism. They just feel the squeeze. And the squeeze is tightening, because we haven't even talked about what happens next. When this concentration of ownership fully matures, when the feedback loop completes, when democracy itself bends to accommodate financial power that eclipses political power, that's where this story goes from concerning to catastrophic. Let me show you what 20 years of this looks like. Not in theory, in lives. Jessica Ramirez graduated from the University of Michigan in 2004 with a degree in economics. She took a job at a mid-sized manufacturing firm in Ohio. Started at $48,000 a year, decent benefits, clear path to advancement. By 2014, she was making $72,000 as a senior analyst. Not rich, but comfortable. She bought a house, started a 401k, felt like she was building something. Then something changed. Between 2014 and 2024, Jessica's salary increased to $81,000. 13% over 10 years. During that same period, her company's revenue grew 47%. Profits grew 62%. The stock price tripled. Jessica's 401k grew too, but her wages stagnated. She couldn't figure out why. She was more productive, the company was more profitable, but her raises barely covered inflation. What Jessica didn't know, what she had no way of knowing, was that her employer was owned by the same shareholders who owned her employer's 3 main competitors. BlackRock, Vanguard, and State Street held significant stakes in all 4 companies. And when your competitors are owned by the same investors, wage competition dies. Jessica wasn't competing in a free labor market anymore. She was operating in a monopsony disguised as capitalism. By 2034, if current trends hold, Jessica will be making $94,000, 16% growth over 3 decades. Her retirement account will have grown substantially, yes, but the math is brutal. She'll have lost roughly $400,000 in lifetime earnings, compared to what she would have made if wage competition had remained functional. $400,000. That's a second house. That's her kids' college paid in full. That's early retirement. Gone. Transferred to shareholders through a mechanism she never consented to and doesn't understand. Now let me show you the other side of that transfer. Thomas Blackwell graduated from Wharton in 2004, same year as Jessica. He went into finance, landed at BlackRock in 2007 as an associate in the ETF division. By 2014, he was a vice president, making $280,000 plus bonus. His job was managing relationships with institutional clients, helping them transition from active to passive funds. Every $1 billion he moved into BlackRock's ETFs generated millions in annual fees. By 2024, Thomas is a managing director, making $1.4 million annually. His compensation has grown 500% since 2004. Not because he works 5 times harder than Jessica, because he sits at the point of extraction. The fees that BlackRock collects from millions of investors like Jessica flow up to compensate people like Thomas. By 2034, Thomas will be making over $2 million annually. He'll retire at 55 with $30 million in assets, most of it in BlackRock stock and funds. He'll own 4 properties. His children will inherit wealth that compounds across generations. Thomas is a nice guy. He's not evil. He's just positioned on the right side of the wealth transfer. Jessica works in the real economy, producing actual value. Thomas works in the financial economy, extracting fees from that value. And the system rewards Thomas 100 times more than Jessica. Here's what most people get wrong about this. They think it's about individual choices. Work harder, get a better job, learn to code, start a business. But when the ownership structure of the entire economy is designed to suppress wages and elevate capital returns, individual effort becomes irrelevant. You can be the hardest worker in America and still fall behind. Not because you failed, because the game changed while you were playing it. Think about the visualization here. 2 lines on a graph. One line is worker wages, adjusted for inflation, nearly flat from 1980 to 2024, barely rising. The other line is corporate profits, steep, climbing, accelerating. The gap between those lines is the wealth transfer, and that gap is widening. Because as BlackRock's ownership concentration increases, their ability to suppress competition increases, which means profits rise faster, which attracts more money into index funds, which increases BlackRock's ownership concentration. It's a loop, and we're nowhere near the end of it. Let me show you what this does to entrepreneurship, to innovation, to the idea that America is the land of opportunity. Maria Santos immigrated from the Philippines in 1998. She worked as a nurse for 15 years, saved every dollar she could, and in 2013 opened a small urgent care clinic in suburban Phoenix. It was thriving by 2018. 3 full-time doctors, 10 nurses, serving a growing community. Maria was living the American dream. Then CVS and Walgreens started opening minute clinics in every neighborhood. Not because there was unmet demand, because their private equity and institutional shareholders wanted growth. BlackRock owns significant stakes in both CVS and Walgreens. These corporations could operate at a loss for years, subsidized by capital from investors who owned hundreds of other profitable companies. Maria couldn't compete. She had one clinic. They had unlimited capital. By 2021, Maria closed her clinic. She went back to working as a nurse for CVS, making less than she'd made as an entrepreneur. By 2034, Maria will be 62, still working shifts, living paycheck to paycheck, with nothing to pass to her children except debt. The clinic she built, the dream she chased, crushed not by market competition, but by capital concentration. Now contrast that with Brian Feldman, a private equity partner who worked on healthcare consolidation deals. He spent 2015 to 2020 acquiring small, urgent care clinics, bundling them into portfolio companies, then selling to larger chains like CVS. Each deal earned him carried interest, the 20% of profits that private equity partners receive. By 2024, Brian has made $47 million. He didn't cure anyone. He didn't provide care. He facilitated consolidation. And the largest investors in his private equity fund? BlackRock, Vanguard, State Street. They provided the capital that crushed Maria's dream and paid Brian's fortune. By 2034, Brian will be fully retired, 48 years old, with over $80 million in assets. Maria will still be working, same industry, opposite outcomes. This is the first microhook. The realization that the American dream isn't dead because people stopped trying. It's dead because capital concentration made independence impossible. When BlackRock and its peers own pieces of every major corporation, those corporations can use their scale to destroy small businesses. And the system calls this efficiency. Let's zoom out. What does this do to entire communities, to cities, to regions? Cleveland, Ohio used to be a manufacturing hub. Tens of thousands of middle-class jobs in steel, automotive, machinery. Between 1980 and 2010, most of those jobs disappeared. Offshoring, automation, competition from China. The standard story. But between 2010 and 2024, something else happened. The companies that remained, the suppliers and service providers, all got acquired by larger firms, backed by private equity and institutional investors. Local ownership disappeared. Profits that used to circulate in Cleveland, spent at local restaurants, local stores, local services, now flow to New York, San Francisco, London, to fund managers, to shareholders. Cleveland's economy became a tributary, feeding a river that flows somewhere else. By 2034, analysts project Cleveland's median household income will be 37% below the national average. Not because Cleveland lacks educated workers or infrastructure, because Cleveland's economic output is owned by people who don't live in Cleveland, who've never been to Cleveland, who vote the shares of Cleveland's employers to maximize returns extracted from Cleveland. Now look at San Francisco. Different trajectory. San Francisco's economy is tech, and tech companies, especially pre-IPO, have resisted the index fund takeover longer than other industries. Founders maintained control. Venture capital, not passive funds, dominated cap tables. This created a decade where San Francisco actually saw wage growth, wealth creation, and upward mobility. But that window is closing. As tech companies mature and go public, BlackRock and Vanguard accumulate shares. By 2024, BlackRock is a top 10 shareholder in Apple, Google, Microsoft, Meta, Amazon. The same ownership structure that killed competition in airlines, banking, and healthcare is now embedded in tech. And you can already see the effects. Big tech companies stop competing as aggressively. They acquire potential competitors instead of outcompeting them. Instagram, WhatsApp, YouTube. Bought, not beaten. And the regulators, who should block these acquisitions, often don't. Why? Because BlackRock owns shares in both the acquirer and the target. The merger increases shareholder value for BlackRock either way. By 2034, San Francisco will look more like Cleveland than people think. High costs, stagnant wages, wealth flowing out to institutional shareholders. The tech boom will be over. What remains will be managed by BlackRock. Here's the question nobody wants to ask. What happens when this reaches its logical conclusion? When BlackRock, Vanguard, and State Street collectively own voting control of 70% of the U.S. economy. We know what happens. We've seen this before. Not in America, but in other systems where ownership and power concentrate without checks. Think about the visualization, a pyramid. At the top, 3 asset managers. Below them, 500 corporations. Below those corporations, 330 million people. Wealth flows up. Power concentrates. The people at the bottom, the workers, the consumers, the small business owners, they generate the value, but they don't own it. They don't control it. They don't benefit proportionally from it. This isn't capitalism. Capitalism requires competition. This is neo-feudalism. A lord class of asset managers, a vassal class of corporate executives, and a peasant class of workers. You can move between these classes theoretically, but the structure ensures most people stay where they're born. This is the second microhook. The system is sustainable for the top, catastrophic for the bottom, and completely legal. Now here's the unexpected twist. The people at the top don't think they're doing anything wrong. Larry Fink genuinely believes BlackRock serves a social good. Lower fees for investors, efficient markets, stakeholder capitalism. He writes letters to CEOs about climate change, diversity, long-term value creation. He sees himself as a responsible steward, and in a narrow sense, he's right. BlackRock does lower fees. BlackRock does promote some positive social policies. But the structure underneath, the common ownership, the voting concentration, the suppression of competition, that structure extracts more wealth from workers and consumers than BlackRock could ever return through fee savings or ESG initiatives. It's a magic trick. Make people focus on the low fees, while the ownership structure raises their costs everywhere else. Your airline ticket costs more. Your wages grow slower. Your startup gets crushed by a BlackRock-backed incumbent. But hey, your ETF only charges 0.03%. You're saving $12 a year on fees, while losing thousands in wages, prices, and opportunities. Remember Marcus from Part 3, the baggage handler whose wages stagnated while airline profits soared? Marcus is 53 now, in 2024. He'll work until he's 67, maybe 70. His retirement account has about $280,000. Sounds decent until you realize that in an economy with functional wage competition, he'd have closer to $450,000. That $170,000 gap is the difference between retiring with dignity and working until his body fails. And Marcus still doesn't know why. He blames himself. He thinks he should have worked harder, should have gotten more education, should have switched careers. But the truth is simpler and more brutal. The structure stole from him. Legally, quietly, continuously. By 2034, 20 million American workers will be in Marcus's position. Retirement accounts that look okay on paper, but represent massive wealth transfers they never consented to. And on the other side, 20,000 people like Thomas Blackwell, who didn't work harder or create more value, but positioned themselves at the point of extraction, will control more wealth than the bottom 50% combined. This isn't a future projection. This is the current trajectory. It's already happening. You're living in it right now. The question is, what comes next? When enough people realize the game is rigged, when the gap between those who own and those who work becomes too obvious to ignore. Because once you see it, you can't unsee it. And that brings us back to today, to you, to the choice every person watching this has to make. So here we are, January 2025. BlackRock manages $10 trillion. By the time you finish watching this video, that number will have grown. Not because of some brilliant investment strategy, because money keeps flowing into index funds, automatically, from your paycheck, from pension contributions, from retirement accounts that deduct a percentage every month and buy the same ETFs. The machine feeds itself. Remember Michael Chen from the beginning? The software engineer who bought his first index fund in 2019, feeling like he'd finally joined the investor class? I called him last month. He's still in San Jose, still working at the same tech company, still contributing to his 401k. His portfolio has grown from 8,000 to 32,000. He's proud of that. He should be. But when I asked him if he'd ever voted his shares, he laughed. He didn't even know he had voting rights. Or rather, he had economic rights. BlackRock had the voting rights. Michael has been an investor for 6 years. He's never voted once. And he's not unusual. He's the norm. Picture this. Millions of Americans, all thinking they own stock, none of them voting. All of that power concentrated in 3 firms. This is the pattern that runs through everything we've discussed. Ownership distributed, power concentrated. And the concentration is invisible because it's called something else. Asset management, passive investing, index funds. The words sound democratic. The structure is oligarchic. Now let me show you what's happening right now. Not 10 years ago, not in some dystopian future. Today. Angela Park is a 34-year-old teacher in Portland. She earns $58,000 a year. She has a Roth IRA with about $47,000, mostly in Vanguard and BlackRock index funds. She votes in every election, local and national. She cares about policy. She believes in democracy. But Angela has never once considered that her retirement account gives her voting power in Apple, Microsoft, and Amazon. Power she's never exercised. Power she doesn't even have access to. Last month, Apple had a shareholder vote on executive compensation. The CEO's pay package was worth over $63 million. BlackRock and Vanguard, voting on behalf of millions of investors like Angela, approved it. Angela, whose entire net worth is less than 1/1000th of that CEO's single-year compensation, helped approve it without knowing. This is the mechanism. Distributed ownership, concentrated voting. And Angela, who would likely vote differently if given the choice, has no mechanism to express that choice. The system isn't designed to ask her. Contrast Angela with Richard Weatherby, a managing director at State Street. Richard doesn't manage $10 trillion like BlackRock. State Street only manages $4 trillion. But Richard's job is similar to Thomas Blackwell's from earlier. He helps institutions transition to passive strategies. He advises on portfolio construction. He collects fees on billions in assets. Richard made $950,000 last year. He also has about $8 million in net worth, much of it in State Street stock and index funds that he manages. Richard votes in elections too. But unlike Angela, Richard's financial interests align perfectly with the system we've described. He benefits from concentration. His wealth grows as passive investing grows, and passive investing grows as more people like Angela make the rational individual choice to buy low-fee index funds. Richard isn't conspiring. He's not sitting in a dark room plotting oligarchy. He's just positioned on the right side of the extraction. Angela generates value as a teacher. Richard extracts fees from the system that invests Angela's savings. One is upstream, one is downstream, and the river flows one direction. Here's the contrarian point nobody talks about. This system could theoretically be fixed without destroying index funds. The solution is simple. Pass-through voting. Let the actual beneficial owners vote their shares. Create a platform where Michael Chen gets a notification when Apple has a shareholder meeting. Let him vote directly. Or, if he doesn't want to vote, let him delegate to someone other than BlackRock. A union. An advocacy group. A political party. Anything that represents his actual interests, rather than BlackRock's institutional interests. This technology exists. It's not complicated. Blockchain could solve this in about 6 months. But it won't happen. Because the current structure benefits the people who would need to approve the change. BlackRock, Vanguard, and State Street don't want pass-through voting. It would eliminate their power. And the politicians who could mandate it receive donations and support from the financial industry that profits from the status quo. The system is self-reinforcing. The very structure that concentrates power also protects that concentration. Now here's what you need to understand about your own situation. I'm not going to tell you to sell your index funds. I'm not going to tell you to buy them either. That's not the point of this video. The point is to show you the architecture, the mechanism, the truth about what you actually own versus what you think you own. Once you see it, you have 3 options. First, accept it and participate. Own index funds. Benefit from the returns. Understand that you're feeding the system, but also understand that not feeding the system means paying higher fees and likely getting lower returns. This is morally neutral. You didn't create this structure, you're just navigating it. Second option, divest and go active. Pick individual stocks, hire an active manager, pay higher fees, maybe underperform, but maintain some control over your votes, or at least choose managers whose voting aligns with your values. This is harder, more expensive, but more principled. Third option, political action. Demand reform. Support candidates who understand this issue. Push for pass-through voting legislation. This is the longest path, the hardest path, but the only path that changes the system rather than adapting to it. Here are the 3 questions you should ask yourself, not for financial advice, but for clarity. Do I understand where my money actually goes and who controls it? Am I comfortable with someone else voting shares I think I own? And if this system continues for another 20 years, will the America my children inherit still resemble capitalism or something else entirely? Let me close with this. We started with Larry Fink's $100 million loss in 1986. That failure taught him that risk management is power. He built Aladdin. He built BlackRock. And in 36 years, he built the largest concentration of ownership in human history. Not through force, not through fraud, through a legal structure that markets itself as democratic while functioning as oligarchic. John D. Rockefeller built an oil monopoly. It took 41 years to break up. J.P. Morgan built a financial monopoly. It took 20 years to dismantle. BlackRock has built an ownership monopoly in 36 years, and it's still growing. The question isn't whether BlackRock is powerful. Obviously it is. The question is whether that power is compatible with the capitalism, democracy, and freedom we claim to value. When one company is the largest shareholder in Apple, Microsoft, Amazon, ExxonMobil, J.P. Morgan, Pfizer, and 494 other S&P 500 companies. When one AI system manages $21 trillion in assets. When one CEO's letter shapes corporate policy more than most legislation. When your vote disappears into a black box you never agreed to. That's not a free market. That's not democracy. That's something else entirely. And we built it. Not through conspiracy, through millions of rational individual choices that created an irrational collective outcome. The signature line, the one that captures everything. You own nothing. BlackRock owns everything.
And the beautiful horror of it is that it's all completely legal.
This isn't the end of the story. This is the middle. The system is accelerating. The concentration is increasing. And most people still don't see it. But you do now. And once you see it, you can't unsee it. The question is what you do with that knowledge. Because doing nothing guarantees that BlackRock's 10 trillion becomes 20 trillion, that their 7% becomes 10%, that the oligarchy becomes absolute.
Not through conquest, through compound interest and index funds.
Welcome to the world BlackRock built. Population, everyone.